I want to start calmly today because investing conversations are often loud, confusing, and stressful, even for people trying to do everything right. If you are here, it probably means you have searched for answers, watched many videos, and still felt unsure about your investing direction. Before we go deeper, if you appreciate clear, calm money conversations, please gently like this video so it reaches others quietly struggling too. You can also comment where you are watching from, because I read those comments and they help guide future videos on this channel. And if you want more videos like this, about building wealth without panic or hype, consider subscribing for future conversations together. Today, I want to talk about ETFs, but not in the usual way people talk about tickers, charts, or short-term predictions. Instead, I want to talk about how your ETF choices quietly shape the kind of life you will experience 10, 20, or 30 years from now. Most people believe investing mistakes happen because they picked the wrong ETF. But I have learned the deeper problem is different. The most dangerous mistakes rarely feel like mistakes at all, because nothing breaks immediately and nothing looks obviously wrong. You invest regularly, stay disciplined, and still wake up years later feeling uncertain about where all that effort actually led. That quiet disappointment is what I want to help you avoid, because it is far more common than people like to admit. So the real question is not which ETF is the best, but which future your current investing behavior is slowly building. If you keep investing exactly the way you are today, what does your daily life realistically look like decades from now? That question may feel uncomfortable, but clarity often begins with discomfort, especially when money decisions affect long-term freedom. I have watched many smart, disciplined people follow good advice and still end up frustrated with their financial outcomes. Not because they lacked intelligence or effort, but because no one helped them connect investments to real-life goals. ETFs are powerful tools, but tools are only useful when you understand what you are actually trying to build with them. Without that clarity, even great ETFs can quietly move you toward a life you never intentionally chose. To make better decisions, we first need to understand the world we are investing in right now. And honestly, the environment today makes confusion easier and clarity harder than it has been for previous generations. Right now, investing feels harder because everyday life costs keep rising quietly, even when headlines say inflation is cooling down. According to recent data from the U.S. Bureau of Labor Statistics, prices remain higher than they were just a few years ago. That slow increase does not feel dramatic monthly, but over decades, it quietly erodes savings and reduces financial breathing room. At the same time, the stock market continues doing what it has always done, moving through cycles of excitement and fear. When you look back at nearly 100 years of market history, volatility stops looking like danger and starts looking normal. There were incredible years, painful crashes, long recoveries, and uncomfortable stretches where patience mattered more than prediction skills. Even during the worst decades, markets mixed sharp declines with powerful rebounds that rewarded people who stayed invested. Understanding this long-term pattern makes daily headlines feel less threatening and helps you respond calmly instead of emotionally. Most investing stress comes from reacting to short-term noise while forgetting the bigger system quietly working underneath everything. This is why structure matters more than predictions, especially when your money is meant to support real life. Without structure, people chase trends, panic during normal declines, and constantly switch strategies, damaging long-term results over time. I see this pattern repeatedly with beginners who are intelligent, motivated, and genuinely trying to make responsible decisions. Their problem is not effort or discipline, but the absence of a clear framework guiding their investment choices. To navigate markets calmly, I like to think about wealth as something powered by a few simple engines. This mental model helps connect abstract investments to practical outcomes you actually feel in daily life over time. T3. Every portfolio, no matter how complex it looks, is really a balance between income, stability, and growth drivers. These three forces work together to shape how your money behaves during good years and difficult periods ahead. Once you see investing through this lens, individual ETFs start making sense within a much larger picture overall. Instead of asking which ETF is best, you begin asking which role each investment is meant to play. That shift in thinking reduces stress dramatically and creates decisions aligned with the life you actually want long-term. I call these forces engines because each one pushes your financial life in a very different emotional direction. The first engine is income, which creates steady cash flow and reduces pressure to sell investments during difficult markets. Income matters because it gives people psychological safety, especially when headlines turn negative and prices move unpredictably. The second engine is stability, which smooths volatility and protects you from making emotional decisions during market downturns. Stability does not eliminate losses, but it prevents panic and helps you remain invested when patience matters most. The third engine is growth, which allows your money to compound faster than inflation over long periods of time. Growth feels uncomfortable because it comes with volatility, but it is the engine that creates meaningful long-term wealth. Every investor uses all three engines, even if they have never consciously thought about them this way. The difference between portfolios is simply how much power each engine is given within the overall structure. Once you understand this balance, investing stops feeling random and starts feeling intentional and controllable. Now I want to walk through 3 ETF portfolios, each designed around a different balance of these engines. None of these portfolios are perfect, but each one serves a very specific type of person and future lifestyle. The first portfolio is designed for people who value calm, predictability, and reliable income over maximum growth. This is often chosen by investors who want money working for them without constantly checking markets or prices. They prefer consistency over excitement and value emotional peace more than outperforming market benchmarks. For these investors, the income engine becomes the dominant force guiding most portfolio decisions. This approach reduces stress because cash flow arrives regardless of what markets are doing short-term. It also reduces the need to sell assets during downturns, which is where many long-term mistakes happen. This portfolio is not about getting rich quickly, but about protecting lifestyle and maintaining financial control. For many people, that sense of control is more valuable than chasing the highest possible return. When people ask me why income matters, I usually tell them it is about behavior, not just numbers. Reliable income changes how you react emotionally when markets fall, because you are not forced to sell assets. Instead of watching prices nervously, you receive cash that continues arriving regardless of short-term volatility. This steady cash flow acts like an emotional buffer during uncertain periods, making long-term discipline easier to maintain. Many investors underestimate how powerful this psychological effect becomes during extended market downturns or recessions. With income arriving consistently, market declines feel less like emergencies and more like temporary price fluctuations. That mindset shift alone can dramatically improve long-term results, even without chasing higher returns. Income-focused portfolios often sacrifice some upside, but they compensate by increasing investor consistency over decades. Consistency matters because most wealth is lost through emotional decisions, not through poor asset quality. This portfolio is designed to reduce those emotional mistakes by prioritizing cash flow and stability together. Typically, income portfolios use ETFs that generate dividends from diversified, established businesses across multiple sectors. These companies tend to be profitable, mature, and less sensitive to economic shocks than high-growth startups. Bonds often play a supporting role here, adding stability and reducing volatility during equity market stress. While bonds may not excite investors, they quietly perform an important defensive function within this structure. The goal is not to eliminate risk, but to smooth the journey so investors stay committed long-term. Over time, reinvesting dividends compound steadily, even when markets experience long stretches of uncertainty. This slow, predictable compounding appeals strongly to people who prioritize peace of mind over aggressive growth. For retirees or near retirees, this portfolio often feels especially comfortable and emotionally sustainable. But even younger investors sometimes choose this approach to reduce stress during demanding life phases. The key idea is simple. Income buys flexibility and calm when markets test your patience. However, not everyone wants to focus entirely on income, especially when they still have many productive investing years ahead. Many people want meaningful growth, but without constant anxiety that aggressive all-in strategies usually create emotionally over time. This is where the balanced portfolio becomes powerful, offering steady progress while reducing emotional swings during unpredictable markets. I often describe this approach as progress without panic, built for people quietly building wealth alongside real life. Balanced portfolios deliberately spread attention across income, stability, and growth engines instead of relying on one force alone. TOEIC. This balance lets investors participate in upside markets while softening emotional stress during inevitable downturns and corrections ahead. When markets rise, growth assets quietly push returns higher without overwhelming the entire portfolio structure over time consistently. When markets fall, income and stability work together to cushion losses and protect long-term investor confidence levels psychologically. This constant push and pull creates a smoother journey, which is critical for maintaining discipline over decades investing. Most working professionals find this structure sustainable while balancing careers, families, responsibilities, and long-term financial goals together calmly. QD. They do not need to constantly monitor charts or react emotionally to every headline or market movement daily. Instead, the portfolio compounds quietly in the background while life unfolds and priorities naturally change over time steadily. Balanced portfolios usually combine diversified equity ETFs with dividend-focused and defensive holdings for resilience across market cycles long-term. This diversification reduces dependence on any single sector, region, strategy, or short-term economic outcome significantly over long periods. It also lowers the risk of catastrophic mistakes caused by overconfidence, fear, or poorly timed decisions during volatile markets. Over long horizons, this structure often delivers attractive returns, with far less emotional strain for disciplined investors consistently. The trade-off is straightforward. You sacrifice some extreme upside in exchange for stability and consistency over long-term investing. For many investors, that trade feels reasonable and aligned with their broader values and life priorities today, long-term. Wealth building becomes a background process, supporting life quietly instead of dominating attention every single day, emotionally draining. That is why balanced portfolios often form the foundation of long-term plans for sustainable financial independence and peace of mind. Over time, balanced portfolios teach investors an important lesson about patience, discipline, and letting systems work quietly. Instead of reacting emotionally, investors learn to trust structure, rebalance calmly, and stay focused on long-term outcomes. This steady approach reduces regret, because decisions are guided by process rather than fear or temporary excitement. Many people discover they enjoy investing more when it stops demanding constant attention or emotional energy daily. However, some investors eventually realize they want to push harder toward future growth once stability feels established. They begin asking whether accepting more volatility could significantly change their long-term financial trajectory. This curiosity usually appears after confidence grows, experience accumulates, and short-term market swings feel less intimidating. That natural progression leads us to the third portfolio, designed specifically for maximizing long-term wealth creation. The growth portfolio prioritizes expansion almost entirely, accepting volatility as the price paid for greater future potential. This strategy is not about comfort today, but about deliberately amplifying compounding over multiple decades ahead. Investors choosing this path understand temporary losses are unavoidable and often necessary for outsized long-term gains. Emotionally, this portfolio demands patience, resilience, and confidence during periods when results look disappointing initially. Short-term performance may feel frustrating, especially when markets stagnate or decline for extended stretches. However, history shows innovation, productivity, and economic growth tend to reward patient owners over time. Growth portfolios typically concentrate on companies reinvesting aggressively into technology, expansion, and future opportunities worldwide. These businesses may pay little income today, choosing instead to maximize long-term value creation internally. This trade-off can feel uncomfortable, but it allows capital to compound faster without interruptions from distributions. Over decades, That uninterrupted compounding often creates dramatic differences in final portfolio value. The key requirement is emotional endurance, because volatility will regularly test conviction and long-term commitment. For investors who can tolerate discomfort, this approach offers the highest potential reward over an entire investing lifetime. For H, growth portfolios often feel lonely because they look wrong for long stretches, before results eventually appear to patient investors. During these periods, headlines question valuations, commentators warn crashes, and social pressure tempts investors to abandon discipline early. This discomfort is exactly why growth strategies create outsized wealth for those willing to stay committed long-term patiently. Emotionally, investors must accept periods where progress feels invisible despite continued contributions and disciplined behavior over years sometimes. Growth portfolios rely heavily on equities representing innovation, productivity gains, and expanding global economic activity over time consistently. These companies reinvest profits instead of paying dividends, aiming to increase future earnings power steadily for shareholders long-term. Because income is minimal, investors must fund their lifestyle elsewhere without relying on portfolio cash flow during growth phases. This structure rewards younger investors or those with stable incomes who can ignore short-term portfolio movements comfortably today. It is less suitable for investors needing immediate income or emotional reassurance during volatile markets frequently over cycles. Choosing growth means intentionally accepting discomfort today to potentially unlock dramatically greater freedom later in life overall long-term. D. When comparing all three portfolios, the differences become clearer when viewed through life outcomes over decades clearly consistently. Income prioritizes comfort. Balanced prioritizes resilience, and growth prioritizes maximizing future possibilities over time for different investor personalities. None of these approaches are universally superior. They simply serve different human needs and life stages appropriately sometimes. Problems arise when investors choose portfolios misaligned with their temperament, responsibilities, or time horizon realistically today and goals. That misalignment creates stress, second-guessing, and ultimately poor decisions during challenging market periods for many investors globally today. Brace. This is why understanding yourself matters as much as understanding markets and investment products long-term successfully overall. Your portfolio should support your life, not constantly fight against your emotional limits and priorities over decades ahead. When alignment exists, investing feels calmer, decisions improve, and staying invested becomes easier through cycles long-term consistently overall. This clarity allows compounding to work quietly while life progresses without constant financial anxiety or panic over years. Ultimately, the best portfolio is the one you can maintain confidently through every market environment and life phase. Waned. To truly understand these differences, it helps to imagine committing the same small daily amount to each portfolio consistently. Let's say someone invests just $10 a day, quietly and consistently, without skipping contributions for decades. The income portfolio transforms those contributions into steady cash flow that gradually replaces financial stress with predictability. Over time, dividends grow, compounding quietly until monthly income begins covering meaningful portions of everyday living expenses. The balanced portfolio tells a different story, combining rising income with stronger asset growth across long investment horizons. Here, wealth grows faster, yet volatility remains tolerable enough to maintain discipline through multiple market cycles calmly. Many investors find this middle path produces the healthiest relationship between money, ambition, and emotional well-being long-term. The growth portfolio creates the most dramatic contrast, focusing almost entirely on compounding future value rather than income today. For years, progress may feel slow or invisible, while contributions accumulate beneath volatile price movements quietly. Then, compounding accelerates, and the portfolio's value begins separating dramatically from the other approaches over decades. This is where patience transforms into exponential results, creating outcomes that feel surprising even to disciplined investors. Importantly, each portfolio reaches its destination using the same habit: consistent contributions rather than perfect timing. The difference lies not in effort, but in how time is allowed to work within each structure. Same money, same discipline, but very different financial lives emerge depending on portfolio design choices. One prioritizes peace, another balances progress, and the third maximizes future freedom through long-term compounding power. Seeing these outcomes side by side often changes how people think about investing permanently. It becomes clear that strategy matters more than chasing returns or copying someone else's portfolio blindly. Money stops feeling like a scoreboard and starts feeling like a tool shaping future choices. That shift alone can reduce anxiety and improve long-term commitment through inevitable market uncertainty. Understanding these differences prepares us for the final question. Every investor must eventually answer honestly. That final question is not about returns charts or forecasts, but about the life you truly want money to support. Investing becomes simpler when you stop asking what performs best and start asking what actually fits your life. The right portfolio should reduce stress, not add pressure, or force you into constant emotional trade-offs every single day. When money aligns with your values, investing feels calmer, clearer, and far more sustainable across long, unpredictable periods. I have seen people succeed with every portfolio discussed here as long as alignment stayed strong over time consistently. I have also seen people fail with great investments because they chose strategies they could not tolerate emotionally. Success comes from consistency, clarity, and patience, not from chasing whatever looks smartest in any single year to others. Once you accept that truth, investing stops feeling like competition and starts becoming a personal long-term system. Your system should evolve. As your life changes, responsibilities grow, and priorities naturally shift over time for you. There is nothing wrong with adjusting strategies as long as changes are intentional, not emotional reactions to fear. What matters most is staying invested in a way you can maintain through uncertainty and market noise over decades. The best portfolio is not universal, impressive, or popular, but deeply personal, sustainable, and realistic for you long term. If this perspective helped you rethink investing, take a moment to reflect on which portfolio fits you today best. You can share that choice in the comments because reading them helps me shape future videos for this channel. If you value calm, thoughtful conversations about money, consider subscribing to continue learning together here over time consistently. These videos are designed to replace confusion with clarity and help you build wealth without panic over decades. Investing does not need to feel overwhelming when you understand the purpose behind each decision, clearly long-term choices. With clarity, time becomes your greatest ally instead of something quietly working against you over years, financially consistently. The goal is not perfection, but steady progress aligned with the life you truly want long-term for yourself. Thank you for spending this time with me, and I will see you in the next conversation together. Before you leave, take a moment to consider where you are in life and what you truly need next. Are you seeking calm, reliable income, more stability during uncertainty, or maximum growth for a future far ahead? There is no correct answer here, only honest reflection about your temperament, responsibilities, and current stage of life. Choosing the right portfolio today does not lock you forever. It simply gives you direction right now forward. As your income grows, family changes, or goals shift, your strategy can evolve thoughtfully alongside you over time together. Investing works best when it adapts with your life, instead of forcing you into rigid rules that break alignment. If this video helped clarify your thinking, consider sharing it with someone feeling confused about investing today now. Quiet, helpful conversations often reach the right people when they are shared intentionally without hype or pressure online. On your screen, you will see another video that builds directly on what we discussed today together next. That video explores how small, consistent investments quietly turn into meaningful long-term financial freedom over decades steadily. Watching it next can help reinforce these ideas and strengthen your overall investing framework for years ahead consistently. Remember, wealth is not built through intensity bursts, but through calm, repeated decisions over many years without burnout. The market will always fluctuate, but your behavior matters far more than temporary price movements over time consistently. Staying invested with clarity, patience, and alignment is the quiet advantage most people underestimate for decades ahead financially. Over time, those small advantages compound into results that feel surprisingly large and life-changing for patient investors. You do not need perfect timing, perfect information, or perfect confidence to move forward steadily over long horizons. You only need a clear direction and the discipline to keep showing up consistently through changing market cycles. When direction and consistency align, progress becomes inevitable even through uncertainty over long investment journeys for patient people. Thank you again for spending these minutes with me and thinking deeply about your financial future starting today. I look forward to continuing this journey with you in the next video, together with clarity and purpose.